Hello everybody, my name is Steve Mangelson with the Legacy Home Group at Red Rock Real Estate here in St. George, and hot off the press is Q4 2019 real estate market statistics. Under this video you'll see a link if you would like to receive a copy of these. These are statistics that I compile and put together at least once a quarter to kind of give you an overview as to what's happening. Now, one of the biggest reasons that I do this is because I feel like as a real estate professional, one of the best things that I can do to help clients and help people as far as providing them with value is to give them perspective on what the real estate market is doing. Now, some may be wanting to purchase a home, some people may be wanting to sell their home, and others may have no inclination or desire to either buy or sell. The reason I still believe these statistics are important is because it helps you understand the impact that the real estate market is having on your home's value. So even though you may not be in the market to buy or sell, it's important to take a look at these so you can understand market trends and where the real estate market's going. What this enables you to do, and hopefully by interpreting some of this data, is to help you make the best buying or selling decision possible if you are in the market. And so if you have any questions, please reach out to me. You can call me at 435-922-0041. It's 922-0041. I've been tracking this data for many years now. I do it manually. It's not a system that does it. I review it every month, and then I start looking for trends. So we're going to jump right into this. Again, this is Q4, so it's looking at not only the last quarter of last year, but now we have enough data for the year to look at the year entirely. So just look at the very first graph, which is the snapshot of active and pending listings. So the main thing that I want you to see out of this is the trend line. So your blue line is your active listings, your red line is your pending listings. And if you go back to like May of 2008, that's when the gap between the two was the largest, and those two lines really diverge. And back during that time, it's just a function of supply and demand. When we have more supply than demand, it's going to have downward pressure on prices. When we have a higher demand and low supply, you're going to see an upward pressure on prices. And that is what has happened here in Washington County and St. George, really starting, you can see when those two lines start to converge is about March of 2011. And since then, they've been consistently, your active listings have been consistently dropping. We're just over 1,000 right now, compared to back in 2008, where we saw close to 3,000. Why the difference? The main reason right now is because we don't have the number of short sales and foreclosures that we had back then. But also a lot of the inventory is just selling. It hits the market, and the market is a seller's market, and so it's selling off. So the next page that I want you to see, the next graph, is units sold. So the number of residential units. This is not taking into consideration land or commercial or multifamily. This is strictly single family residences, condos, and townhomes, all in Washington County, the number of units sold. So if you look at last year, we ended the year about 4,528 single family residences that sold in 2019. How that compares to previous years is it's almost record breaking. Back in 2018 was really a record-breaking year, but 2019 was right there close. So look at how that compares to previous years, and if you go back to really April 2009, so just over 10 years, you can see that constant increase, or consistent increase, I should say, over the last 10 years. Back in April 2009, we were just under 2,000 homes sold, and now we're at 4,528, so more than double the number of homes sold in the last 10 years. So your next graph is the dollar volume sold. So the previous was the number of units. Now we're looking at the dollar volume, that amount that has been sold. And last year, we're record-breaking by far, is $1.6 billion. $1.6 billion of volume sold. in the last 12 months. That's a 10% year over year increase. The previous number, by the way, the number of units sold, is a 5% increase year over year. So again, look at that trend line from April 2009, consistent going up as prices continue to increase. We're going to talk about why that is here in a minute. Your next graph is probably the most geeky graph. I get a little carried away sometimes looking at some of these because I think numbers tell a story. And you can kind of get lost on this graph a little bit. You can kind of get lost just trying to interpret and read the title. But this is in blue, the quantity sold year over year change, compared to red, which is your volume sold year over year change. So for example, just take November of 2019, the end of that graph, and look at the blue. The quantity year over year change is right around that 5% that we talked about. The number of homes sold year over year change is 5% in positive. The red, which is your volume sold year over year change, was that 10% that we just talked about. So the two things that I really want you to look at is right around May of 2010, that blue line, the quantity, is far above the red line, which is the volume sold. And then look what happens in about March of 2014. Those just flop, with the cross period being right around March of 2012. So if you remember back in 2010, we were selling a ton of homes. The majority of those homes, a large percentage of those homes, were short sales and foreclosures. That's why your volume was lower than the number of homes sold. Conversely, look at March 2014, after those lines cross, and now the dollar volume of those homes is increasing as a percentage year over year, a lot greater than the number of homes. And that's because we had rebounded. We started to sell off more and more of our high-end inventory and reducing the days on the market for the 500,000 plus inventory, really signifying a strong change in the market. Your next graph is total units listed versus the total units sold. So the blue is the number of homes listed compared to the number of homes sold. Again, what we want to look at are trend lines to establish some sort of, if we had a crystal ball and had to guess at what the market's going to do in the future, this is where we get that guess, is by analyzing some of these numbers. But if you go back and look at, again, July, October-ish of 2008, where the disparity, those lines had diverged to their greatest degree, and then they start to converge right around April of 2010, signifying that our market was really starting to, and I really shouldn't say that, it was probably closer to end of 2012, 2013, where you start to see that uptick on number of homes listed and also number of homes sold. The next graph kind of tells that story a little bit differently as a percentage of what percentage of homes that are listed actually sell. Now this is super telling and really valuable information for consumers and real estate professionals. Again, go back to January, right around probably December of 2008, when this number was at its lowest, and it was right around 32%. So let me put this in perspective. You're thinking about selling your house. You invite a real estate professional over to talk to them about hiring them to do that job for you, and you ask them the question, hey, what percentage of homes that are on the market actually sell? And if we were in January or December of 2008, your response would be about 32%. About 32% of the homes that come on the market actually sell back then. Now look at where the market has come in the last 10 years. We are now right about 77% of the homes that are on the market that get listed actually sell. Okay, so what about the other 25% that don't sell in this hot seller's market? Well, some sellers will try to probe the market, stick it on for an outlandish price just to see if they can get it. and don't really have any intentions on moving or selling. They just want to see if they can get that number. Or some sellers are unreasonable and price it way too high, wanting to sell, and then it just sits stagnant for longer than the average days on the market. And then they either have to price reduce and price correct and bring it down, or take it off the market. That's the other 25%. So this is super helpful just to kind of look at marketing efforts. If you're going to hire a real estate professional, you want them to at least match that, at best outpace that market number of about 77%. Your next graph is your average days on the market. Now this is CDOM, which is cumulative days on the market. So if a home's been on the market and then taken off and then put back on 30 days later or 60 days later, it picks up those days from the time that it was previously listed. That's the cumulative days on the market. So right now we're about 62 days on the market, which, again, compare that back to 2010 when we were sitting close to 130, 140 days. So we've literally chopped that in half and then some in the last 10 years. So this is the one that everyone's talking about. This is your your median sale price. So the median is the dead center number. Your average is taking all the numbers and divided by how many there are. And the reason that median is more telling than average is we do have a lot of higher price homes here in Washington County that kind of skew that and throw that off a little bit if we don't use the median. So last year we increased about 5% in our median sales price, and we're at $325 right now. Your average list price is about $375. Our median sale price is right around $325. Now go back and look at January 2012. Median sales price back in January 2012 was $165. So now we're about $325. So in the last 8 years, we've averaged about 12% growth in median price every single year. Now, why is that important to know? Well, on the average over the last 25 to 30 years, the normal, quote unquote, normal price appreciation should be around 4 to 6%, just for a normal market. So if we've been averaging 12% in home appreciation over the past 8 years, one would say, or one would think, that we're about ready for a market correction. The market can't sustain 12% growth over year for an extended period of time. We've got about 8 years. Your normal market cycles are roughly 6 to 8 years. So we're right in now. So will we go through a correction? More than likely, yes. I've been saying for the last year and a half, I think we're due. Is there a bubble? No, there's not a bubble. One of the things to look at is that has been super, super steady growth over that 8 to 10 years. It hasn't been the peaks and valleys that we saw back in 2005, 2006, which what goes up quickly is going to come down quickly. And we saw that huge bubble burst back in 8, 9, and 10. So are we due for a correction? Yeah, I think we are. A normal market correction. What I've been telling people is you're probably looking at somewhere between a 7 to 12% correction over the next 18 to 24 months. That would be my guess of what's coming down the pipe. Now there's a lot of variables that will influence that we'll talk about. Your next one is your year-over-year change in your median sales price. So that median sales price that we just looked at of $325, this is as a percentage how much that is changing year over year. As I mentioned last year, in 2019, we're about 5%. But again, look at starting about November of 2014. What you're seeing there is very slow and steady growth over the last 7 years, which is great. On the average, about 12%. So your next graph is what we call your absorption rate. So absorption rate is defined by, if no other homes came on the market today, how long would it take to absorb or sell off the current inventory that we have at its current rate? And we're at about 3.2 months right now. So 3.2 months is all it would take to absorb all the inventory that we have on the market right now. Your next graph is your mortgage interest rate. So this is the big variable. So I've been thinking that interest rates have been due to go up over the last 1.5 to 2 years. I thought the Fed came out at the end of last year and said that their plans were to raise rates by 3 different times in 2019, and in fact they lowered them. So we're still hovering right around 3%. Here you get to see the mortgage interest rates since 1971. Again, look at that. So really it is, I mean, for the last 15 to 20 years, people that are young couples or young families that are purchasing a home right now have never seen anything higher than a 5%, 5.5% perhaps interest rate on their loan. So this will be the one gauge that really determines whether or not we're going to see some market changes in terms of price, would be in interest rates. With prices rising, should interest rates rise also, it may price some first-time home buyers and such right at the market, or make it difficult for them to qualify and purchase. So that's the one lever that the federal government has to influence the market, with a lot of talks of the U.S. economy going into a recession. Now again, remember what the definition of a recession is. It's 2 consecutive months of declining GDP. This is not as big a deal as a lot of people say it is, especially in the national news. Doomsday is not an economy having a recession. It's only 2 consecutive quarters of having declining GPA, not 2 months, 2 quarters. And so a lot of people think that we may be entering into a recession. I don't know that I have an opinion on that, although I think that this year, 2020, is probably the year to pay attention, if we haven't been, to the numbers and the trends, because I think a change in the market may be coming. So if you have any questions, if you'd like to talk about any of this further, or what it means for you if you are thinking of buying or selling or investing in real estate, please give me a call, 435-922-0041. Would love to talk to you. Thanks, we'll talk to you soon.